Hey, it's September 5th, so this is a roundup of this week's news on Bitcoin and crypto. Bitcoin is facing a 100k warning, while the US government is streaming GDP on chain, real estate is going tokenized, and regulators are finally clarifying spot crypto rules. So let's break this down. What matters most for smart investors? Now, let's start off with the Bitcoin red September warning. Bitcoin risks sliding towards 100k after an 8th-month decline. Sentiment looks fragile. Whilst ETH inflows are still solid, but spot prices keep testing support. For investors, this actually means one thing, as I always keep on explaining in many of my videos. It's very important to maintain that long time horizon on those crypto investments, particularly in Bitcoin, and use it as a long-term hedge for capital and intergenerational wealth preservation and growth. On the news of US GDP goes on chain. Now, the US Department of Commerce this week is now publishing GDP across 9 blockchains, including Bitcoin, Ethereum, Solana. Chainlink and Pyth oracles deliver this data in real time. Why does this matter? This could enable macro-responsive DeFi, programmable finance, and institutional products tied directly to immutable public economic data. Now, as we are seeing more capital, more programmable blockchains, as you know that Ethereum is the smart contract programmable blockchain king, but we are seeing other emerging ones like Solana. We are now seeing Stacks, which is the layer 2 Bitcoin layer programmable smart contract blockchain that is emerging. So we are seeing more smart contract capability blockchains emerging, more fintech operators that are running them, and equally we're seeing more appetite and momentum to create those dApps that will help in the tokenization effort of real world assets on chain. So I would see this picking up speed because the attributes and value proposition behind blockchain is rather clear. It's immutable, it's decentralized, it cannot be tampered with. So it's all the more reason why we're going to be seeing more momentum being picked up as more apps are being created on chain. So tying economic data like GDP and other financial metrics on chain, spearheaded by Chainlink, which is the king of all to Oracle feeds on the blockchain. Well, maybe this is an interesting moment to start exploring and investing part of your portfolio on the likes of Chainlink and Pyth, which is another newbie in the Oracle space. So as more smart contracts being created, we're going to be needing more Chainlink APIs to be integrated into those smart contracts in order to bring in, as I said before, the real life data, which will actually bring in more life into the smart contract dApps on chain. So that is the value proposition and need for oracles and smart contracts, and how this all ties in beautifully within the blockchain ecosystem. So this is going to be picking up speed without any shred of a doubt in the weeks, months and years ahead. This leads into this next segment on real world assets. Now, there is a Chinese developer called the Season Group is now creating a Hong Kong Real World Assets Institute, tokenizing things like private debt, IP, and even NFTs, non-fungible tokens, tied to retail projects in order to unlock liquidity in Chinese real estate downturn. Now, what's the global growth that we are seeing across the real world assets tokenization industry? Well, the RWA market is currently $1.25 trillion in 2025, projected at 43% CAGR through 2029. Hong Kong Securities and Futures Commission 2.0 framework now provides a blueprint for token issuance. Major banks like Goldman Sachs, BNY Mellon are already running tokenized funds, achieving 95% faster settlement, and the total RWA TVL, the total value locked, is up 800% to $65 billion. So this clearly manifests that the momentum is real. And again, I made several videos explaining that real world assets tokenization is going to be, for me, the most buoyant of all waves of blockchain technology, more than DeFi, because it's not just looking at tokenizing financial instruments on chain, it's tokenizing everything else that we can see and touch in the physical analog space. So real assets tokenization for me is so important, and we're going to be seeing an awful lot more investment opportunity, capital being drawn into the space, which will open up more opportunities, not just for the fintech operators, but also for new jobs like blockchain consultant jobs, blockchain developer roles, in order to create those dApps, as I said before, on the blockchain. So there's an opportunity to be had across the entire spectrum. So we need to watch this space. Now this brings into my last piece of news, where we are seeing both the SEC and the CFTC spot crypto rules. Now the SEC and the CFTC, between them, are the financial regulators across securities and commodities exchanges in the United States. Now there's been an announcement that they're both going to be finally working together in order to provide clarity over spot crypto trading, which is a move that signals crypto is being treated as a mainstream asset class instead of a regulatory grey zone. For institutions, this could remove one of the biggest barriers to entry, regulatory uncertainty. So we're going to be expecting a much cleaner market structure, more liquidity, and rising confidence, which makes total sense because, as I said, we've got the Genius Act being approved in the United States, and the Clarity Act is very close to being ratified in I think at the House of Representatives. So when that happens, that's going to really push the momentum and the bullish sentiment across the entire crypto industry, including Bitcoin, right, into the next rally. So really, I can't emphasize enough, we need to invest part of our physical analog wealth into digital assets, Bitcoin, and maybe a handful of real asset tokenization projects in the short to medium term. I've already given you a clue to Chainlink, definitely should be part of that list. And lastly, I want to leave a couple of quick mentions. This Bitcoin scarcity. The institutional demand now outpaces miner supply by 4-1, which means long-term bullish tailwind. So as more demand is being pushed into Bitcoin and the supply is limited, there's currently 19.9 million that's been mined out of the 21 million. So it's increasingly getting more difficult to mine new Bitcoins, and there's very little of it going around, whether it's institutions, sovereigns, and retail investors like you and I. And lastly, MicroStrategy, now Strategy, is now eyeing itself to be approved into the S&P 500. Now, what would this mean if they are approved? It would force passive funds to buy Bitcoin exposure via MSTR, which is the ticker symbol of the common stock, which is indirect but powerful inflows into the Bitcoin ecosystem. So, rather interesting round of the news I've given you today. An awful lot is going on, an awful lot that's happening across the spectrum. If you enjoyed today's episode, please don't forget to hit the like button, to share the video to other colleagues, friends and family. And if you haven't done so already, so please subscribe to my channel, as I regularly publish interesting videos such as these, anything to do with Bitcoin, real asset tokenization and the future of finance. So, as always, the message always remains the same. Invest wisely and invest in Bitcoin. Until next time.